Imagine you have money, but there's no bank, no account, no card, no app, no password. If you want to keep your wealth safe, you have to put it somewhere. Under the floor, inside a chest, with a relative, in a temple, with a merchant you hope you can trust. And if you want to borrow money, there's no clean online form, no credit score, no automatic approval. And physical wealth had a problem. It could be stolen, it could rot, could burn, be lost, and it could be very hard to move. Before banks, people solved this problem in pieces. The first solution was not a bank in the modern sense, it was storage. In ancient societies, temples and palaces often became places where wealth could be held. They were large, protected, had records, they had authority. They were some of the few institutions people recognized as stable. If you had grain, silver, or other valuable goods, a powerful institution could store it, record it, lend it, or redistribute it. This was not banking with debit cards and checking accounts, but the basic shape was already there. A place people trusted, a record of who owned what, a way to lend value into the future. Because banking is not only about storing money, it is about moving value through time. If someone has grain today, and someone else needs grain before harvest, a loan can connect the present to the future. The borrower promises to return more later. That extra amount is interest. Interest may feel like a modern financial invention, but the basic idea is ancient. If someone gives up resource today, they often expect compensation tomorrow. So before banks, there were lenders. Sometimes they were temples, merchants, wealthy families, landlords, or even neighbors. And lending was personal. The borrower was not just a file. They had a name, a family, a reputation, a piece of land, a crop, a relationship, or collateral. If they failed to pay, the consequences were not just numbers on a statement. They could become social, legal, or even physical. Debt was visible. People knew who owed whom. That is very different from modern finance. Today, debt can be created quietly by an app, a card, a bank, or an algorithm. A person can owe money to an institution they will never meet. In the old world, money was less abstract, but that did not make it simple. The problem was trust. If you lend to one person, you have to judge that person. If you store money with one merchant, you have to trust that merchant. If you send value across distance, you have to trust messengers, roads, rulers, weights, seals, and records. Every transaction carried a question. Will this promise hold? This is where written records changed everything. People began writing down debts, deposits, transfers, and obligations. A clay tablet, a marked stick, a sealed letter, or a piece of paper could turn memory into evidence. That sounds boring, but it was revolutionary. A record lets trust travel farther than a handshake. If two people know each other, they can remember a promise. But if two cities trade, memory is not enough. They need documents, witnesses, seals, and ledgers. And in a world with modern banks, the ledger was one of the most powerful inventions in finance, because a ledger does something almost magical. It turns messy human promises into organized numbers. And once promises can be organized, they can be traded, transferred, enforced, and scaled. A merchant in one city could owe another merchant somewhere else. A trader could carry a written instruction instead of carrying coins. A trusted network could move value without physically moving all the metal. Eventually, merchants developed tools like bills of exchange and letters of credit. The idea was simple but powerful. Instead of carrying a bag of coins across a dangerous route, a merchant could carry a document that represented a claim. The paper was not the wealth itself. It was a promise that the wealth could be delivered somewhere else. This is one of the biggest shifts in money history. Money slowly stopped being only a thing. It became a relationship, a claim, a record, a promise. And the more trade expanded, the more people needed a specialist to manage those promises. That is where banking starts to look familiar. In medieval and early modern Europe, merchants, money changers, and goldsmiths began performing functions we now associate with banks. Money changers helped people convert one coin into another. This mattered because different rulers issued different coins with different weights, metals, and credibility. Merchants helped move across cities. Goldsmiths held precious metal for safekeeping. And over time, those goldsmiths discovered something important. People who deposited gold did not all come back for it at the same time. If 10 people stored gold with a trusted goldsmith, maybe only 1 or 2 would ask for it in a given day. That meant the goldsmith could issue receipts. At first, those receipts were proof that gold was stored somewhere. But eventually, people could use the receipts almost like money. If everyone trusted a goldsmith, the paper claim could circulate without the metal moving. This is the same strange idea again. The money is not moving. The promise is moving. Banks do not simply guard money. They transform it. They take money that is sitting still and lend it to people who want to use it now. They connect savers with borrowers. They turn idle value into active credit. And this is useful. It can help businesses grow, homes get built, trade expand, and people smooth out the timing of life. But it also creates risk. Because if too many people demand their money at the same time, the system can break. A bank may be trusted on Monday and destroyed by doubt on Tuesday. Not because every loan failed at once, but because trust failed at once. This is the paradox of banking. The system is built on trust, but it also multiplies trust into something fragile. Before banks, risk was often personal and local. You trusted one merchant, one lender, one family, one strong box. Modern banking gathered those relationships into institutions. That made finance much more powerful. It also made failure more connected. One bank could affect thousands of people. One panic could spread through a city. And one rumor could turn a stable institution into a line of terrified depositors. This is why modern banking eventually needed rules. Reserves, audits, central banks, deposit insurance, and government oversight. Not because bankers became magically trustworthy, but because trust had become infrastructure. And infrastructure needs support. This is the deeper answer to the title. What did people do before banks? They still stored value, they still borrowed, they still lent, they still made promises, they still paid interest, they still worried about theft, fraud, default, distance, and trust. They just did it through families, temples, merchants, moneylenders, goldsmiths, and written records. Banks didn't invent the need, they organized it. They took old human problems and put them inside a building, then inside a ledger, then inside a national system, and then inside a screen. That is why your banking app feels so ordinary now. You open it and see a number. But behind that number is one of the oldest questions in human society. Who can I trust with what I have? Who can borrow from the future? Whose promise counts? And who keeps the record? Modern banks can feel cold, technical, and impersonal, but they are built on something deeply human: fear of losing what we have, hope of getting what we need, and the belief that promises written down today will still mean something tomorrow. That is what a bank really is. Not just a vault, not just an app, not just a company with fees and accounts and passwords. A bank is a machine for storing trust. And once you understand that, modern money starts to look different. Your account balance is not just money sitting somewhere. It is a claim inside a system. Your loan is not just money borrowed. It is a piece of the future pulled into the present. Your payment is not just a number moving across the screen. It is a promise being settled inside a network most people never see. Before banks, people carried trust in memory, reputation, metal, grain, seals, and paper. Now, we carry it in apps. The form changed. The old question did not. Because money has never been only about coins, cash, or numbers. Money is about trust. And banks became powerful because they learned how to hold it, record it, lend it, and sometimes lose it. If this changed the way you see money, watch the next video on the app that turned sports into a casino. Subscribe for more videos that explain the hidden systems behind money, business, and modern life.